When you look at Chinese stocks and you look at Alibaba, Tencent, JD, you would think, hey, these are already cheap, but Baidu. Baidu is trading at an 8 forward PE. It's kind of classified as the Google of China, and maybe that's why so many people are interested. When you think, hey, a business like Google at an 8 PE in a growing market like China, that is probably a bargain. But Baidu, while yes, it offers some services like Google in China, but it has not the same position as Google. They make most of their money in the online marketing services, and there is little to no growth here overall. Yes, they have grown a bit during the pandemic, but since then, it has stagnated. Monthly active users have even declined sometimes. When it comes to Baidu, they bring out great products in the beginning, they're the first movers, but they always fail to execute, so their lunch keeps getting eaten every time. Search ads in China are not making up much of a market anymore. This is the search business. This is Baidu, and it is getting squeezed and squeezed and squeezed every year. And sure, in the beginning, it was easy to grow. There were no real competitors. Baidu was the only player, but now that there is actual competition, since 2018 they've grown revenue by around 30%. Not bad growth, but it is also not high growth. And my worry is that if you invest in Baidu, their core products are slowly getting disrupted. And of course, you can always add on new products. They have their intelligent driving, they have their cloud. But here they're already getting beaten by example Tencent and Alibaba. So each business that Baidu enters, where they may be the first movers, sure, you get revenue growth in the beginning, but slowly over time that business deteriorates. They say they're going into autonomous ride-hailing services, robo-taxis. They had a bunch of rides already, well, 899,000 might sound impressive for me as a European. China, with over 1 billion people living there, that's not many rides. But hey, this might be the future for the company. If they get a huge market share there, they're one of the earliest leaders in there, then hey, that is a big revenue. That alone should value this company a lot. But what if this ends up exactly like their search product? Now, of course, here you also have this giant cash pile that we have known from Chinese companies. Plus, it's usually a bit bigger than in the balance sheet because a lot of the Chinese companies have these long-term investments when it comes to cash. So you also usually need to add long-term investments onto it. Depends on the company, but you should always look at the entire cash pile. And here you have a huge cash pile with very little debt. So the company is not at all at a chance of going bankrupt or something. But then I think, what does Baidu offer me? They're currently not doing share buybacks. Technically they are, but let's be realistic. We have seen Alibaba's share buyback program in comparison. It is just nothing in comparison. Other businesses trading at higher valuations that are buying back way more in shares. And if you think Baidu is extremely undervalued and the business is poised to grow again, then why wouldn't you buy back the shares here? But that is something maybe you don't see as a Westerner. You just see this explosive growth before and now return to normal growth, and you think, hey, once they get their business sorted, it goes back to high growth. But what I see from people living in China, and when I look deeper into Baidu's products, is that they're just not a good company when it comes to executing. Sure, they're the first mover gives them a bit of advantage in the beginning, but eventually it phases out. That could change. But they messed up search, they're currently messing up AI, they have the ride-hailing, maybe that is gonna go well, but usually a company that doesn't change will continue to repeat its mistakes. If they're also flopping ride-hailing, then this company, overall, eventually you can't add on more revenue streams to compensate for the lacking growth in the lower segments. If you keep adding up billions and billions of revenue, but for core businesses already hundreds of billions of revenue growth goes away. And then I'm looking at a company which doesn't give me share buybacks, sits on the cash it has, probably because they need it, because they see that Baidu's times ahead may be challenging and they might need to invest or buy other companies to make up for the issues. Only because a company is cheap doesn't mean it will give you a lot of money in return. Either the company gets re-rated to a new multiple, which I don't see happening with Baidu, or it buys back shares or pays out the dividend. Both is stuff that Baidu is not doing. And I don't see a multiple rearrangement. But let's look at some numbers. Let's see at which price I would maybe consider adding Baidu. For that, let's look. Stock-based compensation, 6 billion yuan, on free cash flow of 23 billion. So let's call it around 17 billion in free cash flow. On 353 million shares, that's 48 in free cash flow per share. Let's just call it 50. $6.9 per share. Now, over the last few years, Baidu has grown at around 4 to 5%. And maybe they're gonna buy back 1% of shares from now on. Let's just call it 8% revenue growth over the next 5 years. Slightly above what they have right now. They could boost this massively if they start buying back shares. But I don't see any indication that the management is seriously gonna do that. They will need it to develop new products, buy other companies, to get their products back in line. 14 multiple, way above what it is right now, but maybe in 10 years they have kind of smoothed out the business. The stock would be $69 per share. Here, we're definitely not getting the 10% return. What happens if they start buying back shares? Let's say 10% and then 8% and a 15 multiple because they'll have higher growing free cash flow per share. Yes, in that case, we would get around a 10% return. Let's be realistic, that is not great. The company would have to continue growing at 5%, what they have done historically, and buy back 5% of shares. But are they gonna do that? Are they gonna use up all their cash to buy back shares? Plus, will they be re-rated at a 15 multiple? Better companies like Tencent and Alibaba are barely at that. Now what if it goes worse? Basically, only the revenue growth plus maybe 1% in share buybacks. And they keep a 10 multiple. Well then, $39 a share, huge downside. And that is kind of a risk with Baidu. What says that the revenue won't continue to decelerate? Because, like I said before, mathematically, sure, you can keep on adding new businesses to it that kind of mask the underlying weakness, but eventually, the older businesses, like Search, are already so big, and there's so many of them, that if you keep adding smaller businesses, it won't compensate for the decline in the other ones. The fact that the management isn't even massively buying back shares right now just shows me they have little to no confidence right now. I'm not adding Baidu, I'm sticking with Alibaba. I might add Tencent in the future, maybe even JD. Baidu for now is not a business I want to own. So what do you think? Write down below. Have a good day.